We need to talk about crude oil because crude oil right now is like at $140 a barrel, but the media is saying it's at $110 a barrel. So are they lying? They're also saying that it's all good, the market is stabilizing, just keep buying stocks. But is it all good? Or is Wall Street hiding a massive $30 premium while the physical supply of oil vanishes? And what does this mean for you and your portfolio? That's what we're talking about today. My name is Nick. I've been a professional investor and unprofessional trader for 24 years. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any assets. Let's figure this out together. Look, I'm not going to waste your time telling you a bunch of stuff you already know. I'm just going to say some quick facts. The Strait of Hormuz is closed. 20 to 30% of the world's oil is not flowing anymore, closer to 20%. This is bad. Many people are pricing in a quick end to this war, but it looks like it's probably going to drag on. And as long as it does, and maybe even after that, Iran has started treating the Strait of Hormuz like a toll booth. Now, here's something you might not know yet. Iran operates a selective toll booth. It's a system that blocks Western link ships, but not Eastern link ships. So a single cargo voyage has exploded to 65 million. Sorry, insurance for a single cargo voyage has exploded to 65 million for Western link ships. So for example, the Ping Shun tanker just transported 600,000 barrels of Iranian crude oil to India. They let them through, that's all good. But mainstream Western refiners are completely blocked from the supply for compliance reasons. So this guarantees that the cost of physical delivery completely decouples from the paper promises traded in Chicago or London. And it's becoming a fractured market, right? Because storage facilities in Saudi Arabia and Iraq are completely full with nowhere to load tankers. OPEC crude output just dropped by roughly 7.5 million barrels per day in March. So is this just a localized shipping issue? Of course it's not. Why did I ask that? That's a dumb question. Not really. It's not. Not at all. Let's look at what happened during the 2008 financial crisis. Back then, physical oil peaked at an all-time intraday high of about $147 a barrel. The global supply chain was stretched thin to its absolute limit, and the resulting inflation shock triggered a massive recession. I mean, 2008, right? The underlying mechanism today is exactly the same, but the geopolitical powder keg is significantly worse. We saw Brent futures post a record monthly gain of, I think it was about 64% in March. That is the steepest monthly rise since the contract was created in 1988. It completely blew past the 1990 Gulf War surge. And in a completely unusual inversion, US landlocked WTI crude is now trading at a premium to Brent just because it's shielded from the shipping risk. I'll translate exactly what this means because it's important to understand. So this physical shortage, it's really bad for the economy. And this isn't a future problem. This cascade effect is happening right now. On March 24th, the Philippines became the first nation in the world to declare a state of national emergency. They import 98% of their oil from the Middle East and only had 45 days of reserves left. In Pakistan, the government just hiked diesel prices by 55% in a single day. It pushed diesel to an all-time record high of 520 rupees a litre, while nationwide protests are erupting over there. It's getting chaotic. Their subsidy fund is just completely exhausted. They can't afford not to charge this much for diesel. In the UK, people in the UK travel a lot, so that's important, right? In Europe, diesel futures just climbed above $200 a barrel. And this isn't just about energy anyway. The UN's Food and Agriculture Organization is warning that global fertilizer prices could rise 15 to 20% in the first half of 2026 because 30% of global fertilizer trade goes through the exact same effective region, the Strait of Hormuz. So we're looking at a global food security crisis driven entirely by physical shipping on top of the oil crisis. Also, oil affects food prices. It's a very bad situation. And while the public is being told to look at the calm paper markets, the smart money is quietly executing a massive K-shaped wealth transfer. Now, the cynical observer would say that the major corporations are using this paper illusion to protect themselves while ordinary consumers bleed out. And the data sort of backs that up, allegedly. Large firms and institutional players are hedging their forward costs by buying these artificially suppressed futures contracts at 110, 111, 112. They lock in that paper discount, but households, small businesses, and ordinary retail investors are forced to pay the physical spot price at the pump, which is way higher. In the US, the national average for gas has just crossed $4 a gallon. I wish I lived in the US because that actually sounds pretty cheap to me, but it's expensive for people in the US. In California, the statewide average is 5.89, so $5.89, with Los Angeles already at $6 and diesel sitting at an all-time record high of $7.56. Wall Street banks are perfectly happy to let inexperienced investors short the paper oil market based on algorithmic ceasefire rumors, which are just not true, right? They're using retail traders as exit liquidity while the institutions secure the actual physical supply way cheaper. They know that the gap is going to close in one of two ways. So either the physical supply magically improves or the futures market reprices sharply upward. Analysts are already warning that a $20 to $50 upward snap in futures prices is entirely possible if this disruption persists. So when the paper price inevitably snaps up to meet the physical reality, the inflation shock will be absolutely devastating. And this is just becoming a massive wealth extraction machine as usual, allegedly. So what does this mean for us? Look, for me personally, I absolutely refuse to play Wall Street's paper games. When there's a $30 disconnect between a financial contract and a physical barrel of oil, that's just a casino. I'm completely ignoring the short-term algorithm noise in Brent and WTI. I'm not trading it. I'm not using it. I'm not buying it. And I'm not trading leverage energy contracts that could blow up in a single headline. You do you. I don't want to mess with it. I don't think it's worth it. I'll see you in the next one.